What is an intelligent investor? The Intelligent Investor by Benjamin Graham is the celebrated book on value investing, and Warren Buffett first read it when he was 19, said it changed his life, and calls it the best investing book ever written. So today let's go over my 5 biggest takeaways from The Intelligent Investor that will make you a better investor. The first thing an intelligent investor understands is the difference between an investor and a speculator. The important distinction is that an investor must first thoroughly analyze the stock and the soundness of his underlying business. Second, deliberately protect themselves against serious loss with a promise of safe return of principal. And third, aspire to adequate but not extraordinary performance. And any deviation from this makes one a speculator. The primary difference between an investor is that he calculates what a stock is worth based on the value of its business. A speculator instead is a gambler who haphazardly bases his investing decisions on prices he thinks others are willing to pay for it. This is what stockbrokers and day traders do. Furthermore, an investor is objective while a speculator is subjective. And ultimately, an investor is rational while a speculator is emotional. Graham urges us to invest only if we would be comfortable owning a stock, even if we had no idea what its daily share price is. And speaking of fluctuating share prices, let's meet Mr. Market. Graham introduces us to Mr. Market, or a personification of the manic-depressive nature of the fluctuations of the stock market. In general, the stock market is very accurate in pricing most stocks. However, occasionally Mr. Market gets them very wrong, such as when he gets caught up in excitement and he increases the price of a stock, or he gets caught up in fear and he decreases the price. But as an intelligent investor, you have already determined the value of your stock, and you don't let these price swings in Mr. Market's mood phase you, and actually you use it to your advantage. Let's say there exists a theoretical stock called Tin Man Fire Stock, or TMF, and the intrinsic value is $1,000. In the first of 2 scenarios, Mr. Market comes in a manic state and says that TMF stock is worth $1,500. Here, the speculator buys the stock because they get caught up in the exuberance of the market movements as TMF stock goes to the moon. However, the intelligent investor sees this as a wise opportunity to sell because they understand the price is above the intrinsic value and they can profit. In a second scenario, Mr. Market comes in a depressed state, saying now the stock price is only $500. Predictably, the speculator panics and they sell the stock when it is low, while the intelligent investor now understands that the stock price is below the intrinsic value and sees this as an incredible buying opportunity. This is one of the great insights that Graham had about stock investing. It is simple advice, but not normally followed in the day-to-day operations of the stock market. This is one of Warren Buffett's favorite chapters from the book, and make sure you stick around to the margin of safety section to learn about his other favorite chapter from the book. But before that, let's go over the 2 types of intelligent investors. Graham defines 2 types of intelligent investors, one who is defensive and one who is enterprising. And it's important for us to know which type we are. The defensive investor is someone who does not want to invest a lot of time or energy into managing his or her portfolio. And as a result, the defensive investor would create a permanent portfolio that runs on autopilot and requires no further effort. The goal of the defensive investor is only to strive to achieve the market average. And quite simply, this can be perfectly achieved by buying a total market index fund. Graham recommends starting with a portfolio of 50% stocks and 50% bonds, with stocks never being more than 75% or under 25%. And the defensive investor should dollar cost average, meaning he invests a fixed amount of money every month regardless of the share price in order to avoid buying too much when the price is too high or too low. And Graham says the majority of us investors are suited to be defensive investors, but there's a small percentage of investors who can excel at picking individual stocks, and these are the enterprising investors. The enterprising investor has the discipline, consistency, and thoughtfulness for stock investing, and they should get better than average returns. And this is where we get into the heart of value investing. By calculating the true or intrinsic value of a company's stock, we can compare it to the current price it is trading on the market and decide if it is worth investing. From the previous example, we saw how knowing the intrinsic value would help us in determining whether to purchase a stock. And when Mr. Market presented a price of $500, because we knew the intrinsic value was $1,000, then TMF stock was at a discount and was worth investing. Graham says to calculate the intrinsic value, we take the average earnings over a certain number of years and multiply it by the capitalization factor of a company. And Graham cites 5 capitalization factors of a company, and they include long-term growth prospects, quality of management, financial strength and capital structure, dividend record, and current dividend rate. Investors can look at a company's annual reports to research these capitalization factors. The calculation of intrinsic value might be beyond the scope of this video, so let's look at the greatest example of an intelligent investor investor instead. Meet Warren, the Oracle. He looks for companies with strong consumer brands, easily understandable businesses, robust financial health, and near monopolies in their markets. Buffett favors steady and sustainable growth in earnings, so the company will be worth more in the future. But Buffett likes to snap up a stock when a scandal or other bad news passes over it, when its price is temporarily low, but the fundamental value has not changed. And next, we get to the concept of margin of safety, which Graham considered the most important concept. The margin of safety is in place to ensure you don't lose money. Think of margin of safety the way an engineer designs an elevator. If he were to design it for 8 people, he would make sure that it was able to hold the weight of 12 people. In other words, the margin of safety is in place to minimize our losses. To the intelligent investor, the margin of safety is the difference between the price you pay and its estimated intrinsic value. And we have previously seen this in action when we bought TMF stock at $500 when the intrinsic value was $1,000. Here, the margin of safety is $500 or 50%. You see, the margin of safety absorbs any miscalculations we may make or any adverse developments for the company. So, for example, if the intrinsic value is really $750, we still profit. Or if the intrinsic value is actually greater at $1,250, we also still profit. As you can see, the future value of every investment is a function of its present price, meaning the higher the price you pay now, the lower your return will be in the future. And this is why Graham considers the margin of safety to be the most important concept. And it's these ideas that have made Benjamin Graham one of the best investors who ever lived. But Graham learned the hard way through feeling the pain of financial loss. He observed his mother borrow money to trade stocks on margin only to lose it all in the crash of 1907. And during the Great Crash between 1929 and 1932, he lost nearly 70%. But he survived and thrived and harvested bargains in the decades that followed. And from 1936 to 1956, he gained at least 14.7% annually versus only 12.2% for the stock market, which is one of the greatest long-term records on Wall Street. So, after reading The Intelligent Investor, the big picture I see is that first, it is important to know the difference between a speculator and an investor. The only reliable way to build wealth is to be an investor. For most of us, it is perfectly adequate to be defensive investors and to dollar cost average the total market. And for the small percentage of us suited to be aggressive investors, we can strive to apply Graham's investing principles in order to fully profit from the fluctuating prices of Mr. Market while minimizing our loss by having a margin of safety. And before Benjamin Graham, money managers were guided by superstitions and rituals. However, Graham was able to provide the analytical tools and emotional framework so that we may become intelligent investors. So if you like this video, check out this playlist on other books I've summarized. And this has been the Tin Man at Tin Man Fire, and we'll see you next time.